All right, Tesla just dropped its latest quarterly report. And wow, it is a wild ride. We're talking huge wins, right next to some numbers that make you scratch your head. So let's just dive right in and unpack what is really going on behind the headlines. So, the big question right off the bat has to be this. Was this quarter a triumph for Tesla, or was it trouble? Because honestly, the numbers seem to be telling two completely different stories at the same time. And that's the puzzle we're going to solve together today. Okay, so on one hand, you've got this absolutely massive number, almost 500,000 cars delivered in just one quarter. That's a brand new record for them, and it's a solid 7% jump from this time last year. So, it looks like demand is still just incredibly strong. And it gets even better. They also raked in a record free cash flow of nearly $4 billion. I mean, that is just a staggering amount of cash. It basically gives them this massive war chest to fund R&D, new factories, and all of their most ambitious projects for the future. But here's the twist. While deliveries and cash are way up, their operating income, the actual profit from their main business, is down a shocking 40% from last year. So how in the world does a company sell more cars than ever and end up with so much less profit? That right there, that is the mystery at the heart of this quarter. To figure this out, we're going to break it down. First, we'll hit the quarter's big story. Then we'll look at the automotive business. More cars, but less profit. After that, we'll uncover a booming part of the company, their energy division. Then we'll see their huge bet on AI. And finally, we'll look at what's on the road ahead. All right, let's jump into part one. This really gets to the core of it, this tension between hitting record scale, just massive size, and at the same time, dealing with seriously squeezed profits. And what's so telling is how this whole story is captured in just these two numbers. You see total revenue, that's the money coming in the door, is up a healthy 12% to over $28 billion. But then you look at the operating margin, how much of that cash they actually get to keep as profit, and it was pretty much cut in half. It fell from 10.8% all the way down to just 5.8%. And hey, for anyone who's not a total finance nerd, don't worry. Operating margin is just a really simple way to check a company's health. Think of it like this. For every dollar they make in sales, how many cents do they get to pocket as profit from their main business? So a lower number, like the one we're seeing here, just means they're getting less profitable. Okay, so where is all this pressure coming from? Well, that leads us right into our second section here, diving into the heart of their automotive business and its big challenge right now, selling way more cars, but somehow making less profit on each one. So on the surface, things look great, right? Total deliveries hit that record we talked about, and it's pretty much all thanks to the super popular Model 3 and Y. But if you look a little closer at the numbers, you see something interesting. While deliveries are up 7%, total production is actually down 5%. That kind of hints that they might be tweaking things in the factories or managing inventory, even while people are still lining up for their main cars. And this chart just lays the whole disconnect bare. It puts those two things right next to each other. You see the revenue bar on the left? It's growing, up 12%. But then look at the operating income bar. It's just plunging deep into the negative, down 40%. So the big question is, what is causing this huge gap? Why isn't all that extra money coming in turning into profit? So why the squeeze? Well, the report points to what's basically a perfect storm. For one, they're spending a ton more money, especially on AI and other big research projects. On top of that, the average cost to build each car actually went up. And to top it all off, a couple of their really high profit revenue streams kind of dried up a bit. Things like regulatory credits, and they also recognized less one-time revenue from full self-driving software. It's a classic case of your costs going up right when some of your easiest profits go down. But here's the thing. While the car business is feeling that squeeze, there's another part of Tesla that is absolutely on fire. So let's talk about the unseen growth engine, the energy division, which just had a record quarter. Yeah, tucked away in their report is this incredible little detail. The energy storage business. We're talking power walls for your house, megapacks for utility companies. It is just exploding. Deployments grew by a massive 81% compared to last year. That is just incredible growth. And this chart really puts that into perspective. I mean, look at this. They went from 6.9 gigawatt hours a year ago to 12.5 now. This isn't just steady growth, folks. This is a massive acceleration. And get this division just posted a record gross profit of $1.1 billion. And it looks like Tesla is just doubling down on this success. They just pulled the wraps off something called Megapack, which is supposed to make building these giant battery farms even faster and cheaper. And they launched a new solar lease program to get more solar on homes. This is becoming a really serious and rapidly growing part of their business. Okay, so we've got a car business that's trading profit for scale, and this booming energy business on the side. But to really understand why they're making that trade-off with profits, we have to look at their absolutely massive bet on the future. And that brings us to Section 4, betting big on AI. You can really think of Tesla's whole strategy as this AI flywheel. So step 1, get as many cars and batteries out into the real world as you possibly can. Step 2, use all that hardware to gather an unbelievable amount of real-world data. Step 3 is to feed all that data into supercomputers to train incredibly powerful AI models. And then the final goal, step 4, is to launch these high-profit AI-powered services like full self-driving and a Robotaxi network right on top of that fleet you've built. And listen, this is not some theoretical plan for the distant future anymore. This is happening now. This quarter, they actually started deploying their next-gen FSD software. They launched their Robotaxi service in the Bay Area, and they massively beefed up their AI training supercomputer. They even put the Robotaxi app out there so anyone in the US and Canada can get on the wait list. The flywheel is officially starting to turn. So let's bring it all home and look at the road ahead. Because when you put all the pieces together, the story of this quarter becomes really clear. Tesla is intentionally and very deliberately trading today's profit for what it believes is going to be a completely dominant, AI-powered future. And look, you don't have to take my word for it. They say it themselves, right in their outlook. They say they expect their hardware profits today will be followed by an acceleration of AI, software, and fleet-based profits. So in other words, this profit dip, it isn't an accident. It is absolutely part of the plan. And that future is getting closer and closer. The new FSD is rolling out as we speak. In 2026, it is shaping up to be a huge year. They're planning for volume production of the Cybercab, the Tesla Semi, and the next-gen Megapack. These are the big bets that they are hoping will pay off big time. Which, of course, brings us all the way back to our central question. This quarter really shows us a company at a crossroads, right? They're sacrificing guaranteed profits today for a shot at a much, much larger AI-driven prize tomorrow. The numbers we just went through, they show the cost of making that bet. The question that's left for everyone is pretty simple. Is it the right move?